Well, 2018 has been a year of twists and turns and peak and turfs. Irrespective of the asset class you invested in, it turned out to be a ugly, brutal, and a rather painful year. From gold to crude, from cocoa to silver, from emerging market currencies to developed market bonds, everything took a hit. So, what is the way forward for 2019? Are we starting the year on a high note, or expectations are still running high? So, to discuss that and to talk about market behavior, which is what the differentiating factor for a long-term investor is, I have with me Morgan Housel for the first time on ET Now. So, Morgan, welcome to India. Thank you for joining us. I hope you're enjoying your stay in India.
Thanks for having me. Happy to be here.
When we started the year 2018, the general mood with global investors, and that was not just restricted to US investors or emerging market investors or Indian markets investors, was that there was no skepticism, there was no cynicism, there was only optimism. How would you view the market mood right now?
Well, I think now it's probably more realistic. I think if you ever get stuck in a trap of viewing everything through an optimistic lens, that nothing can go wrong, that's when you're more likely closer to a breaking point where something's about to go wrong. You know, the biggest risks out there are the stuff that no one is thinking about. That's always the case. And that's almost the definition of risk. It's the stuff that no one's talking about. So if you get to a point in the market where no one's talking about any risk being available, that's when people should get worried. So when I look around today, certainly there's more pessimism today than there was a year ago, but I just view that as a more realistic situation than we were at 1 year ago. It's more uncomfortable for people, but I think it's ultimately healthier.
So are you saying that one should always be a contrarian?
Not necessarily, because I think by definition you can't. And if you ask investors, are you a contrarian? Almost everyone will tell you yes, which by definition can't be the case. Most people are not contrarians. Most people are following the herd. And I think if you're just trying to blindly be contrarian and say, well, if the market thinks this, I'm going to think the opposite, that can be a dangerous attitude as well, because the market is usually right. It's not always right, but it's usually right. So if you're always taking the opposite view, I think those investors tend to have a hard time throughout the life of their career as an investor. I think the good contrarians are only contrarian once in a while, when all the stars align and they can really identify why the narrative of common investors is wrong and why their contrarian view would be right in that case. But they're not always contrarian.
In one of your notes, you've said that more money is lost in waiting for correction rather when the actual correction occurs. So how should one approach this kind of a market where you know that US economy is enjoying what could be called its longest economic expansion? The US bull markets have seen a multi-year bull run. Everyone is waiting for a correction, but the correction is not coming in. So imagine if you sold 2 years ago. Imagine if you sold 3 years ago. You would have missed the best part.
I think, you know, when you're looking at something that's unsustainable, whether that's a big rally or strong economic growth that you know can't go along forever, it doesn't mean that it's about to end. And something that's unsustainable can last for years longer than you expect it to. And so what I look at this as investor, you know, from investing standpoint, is even if you know something's going to end, but you have no idea what the timing is, you can give up a lot of compounding by waiting for that. And certainly, by some statistics, U.S. markets looked overvalued in 2010, you know, almost a decade ago. And if you sold back then, you ruined your career. You can never make up for that. So how I deal with that as an investor, and I think all investors should think in a similar lens to this, is rather than trying to avoid every up and down, setting yourself up so that you can endure the ups and downs, so that you're going to remain invested over time, and you know that the markets are going to decline at some point, but rather than trying to sell and avoid it, you just have a situation where you can say, when it comes, I can just take it, I can endure it, I can take those punches. I think that's a much more sustainable way to invest. And then by doing that, you're not missing the years and years of growth that are going to take place, you know, from the time that something looks unsustainable to the time that it might switch gears.
Why are global gurus, from Howard Marks to Ray Dalio, Stanley Druckenmiller, all of them are in a hurry to call the market top? You know, it's like a race between global gurus. Who calls the peak first?
I would look at what those investors are doing with their money versus, you know, necessarily what they might be saying in terms of a market top or whatnot. Because there are a lot of investors, going back to what I just said, who might think, yeah, this is the top, things are about to change, but they're still invested. Warren Buffett is still massively invested in business and equity and capitalism. So just because, you know, some of these people might be saying things look like they're getting toppy, doesn't necessarily mean that they're selling their investments. But from an outsider's point of view, that's often the message that comes across. So that's how and I would also say of the investors that you just named, from Warren Buffett to Stanley Druckenmiller, they have very different investing strategies. Stanley Druckenmiller is much more of a trader and a macro trader than Warren Buffett, who is just betting on long-term capitalism working. So they have very different strategies, even if they're making similar views on the market.
In today's time, when we are connected, we are informed, we've got a world on Google, we've got apps which tell us every microsecond of price action. Are investors smart now? Are they smarter than what they were, let's say, 15, 20, 25 years ago?
Well, they certainly have much more information than they did back then, but I don't know if they're smarter, and I definitely don't think that they are better or superior at making investment decisions today than they were back then, which I think just highlights the view that good investing is not necessarily about the information that you have or the knowledge that you have. It's about how you behave with money and how you behave with investing. And even though we have much more information these days, the ingrained behavior that we have that drives our greed and fear is no different today than it was 20 years ago or 500 years ago. And I don't think it's going to be any different 100 years from now. I think this is just a natural way of how people make decisions around fear and uncertainty and opportunity.
So where to your mind there is fear in the world, where to your mind there is greed in the world, and where to your mind there's a bubble which will get pricked?
Well, I think those things are everywhere, and they're all over the place. I don't know if there are any really obvious bubbles in the world right now. There's certainly asset classes and economies that look overvalued. But if you're talking a bubble, as I would define a bubble, it's something where a high likelihood where you're not only going to lose a lot of money, but you have no chance at ever making it back. That's how I would define a bubble, and those are very rare. So I think after 1999, and maybe the U.S. housing bubble, a lot of people started saying, what's the next bubble? We kind of just got this idea that bubbles were going to be everywhere. And I don't think that's how they necessarily work. I think bubbles are a very rare thing that might only come about a couple times per lifetime.
So what explains this intense selling in December 2018? The intensity of the sell-off in the Facebooks and the Googles of the world is reminiscent of what we saw in US financial stocks in 2008. It just gets the fear of God back.
Well, I think that kind of volatility is actually very normal in markets. And that's why companies like that will produce higher returns over a long period of time, is because once in a while the returns are very poor and you have to put up with that. If returns were great all the time, there would be no risk. And if there's no risk, there's no opportunity. So that kind of sell-off that we've experienced in the last couple of months, I think that's the cost of admission for gaining long-term returns over a long period of time that investors should see as a very normal and natural part of how markets work, versus something that is signaling that the markets are broken or that there's something is wrong and they need to take an action to avoid that.
Normally bubbles are created because of massive participation, lack of liquidity, or rich valuations. If I look at the lay of the land right now, Apple, in world's biggest consumer company, trading at 12 times. Yeah. Google or Alphabet is not expensive. The so-called outperformers currently are companies which don't have a lot of debt on their balance sheet. In fact, they are zero debt companies. Yeah. So I wonder what will really trigger a selling stampede, or what will really trigger the turn?
I don't think there's any way to guess what that trigger might be, because if you look historically, there's often no real trigger about why something turned. The best example of this is the Great Depression in 1929 and the huge stock market sell-off, the crash in 1929. Go back and look at what was the trigger for that. What was the news that day that made the stock market fall 20 some odd %? And I think most financial historians have, 70 years later are still kind of shaking their heads at what was the trigger. Same with the crash in 1987, or even if you go back to 2008, what were the big triggers? Well, certainly there were banks that were going out of business and failing, but a lot of the triggers that cause market sell-offs are not that obvious. It just tends to be a snowballing of people are selling because other people are selling. And then so because there's no obvious trigger, it makes it just very difficult to predict what the next trigger is going to be.
So I don't want to get this one wrong, but are you of the view that after 8-10 years of a long bull market in US markets, which ultimately is the most important market for global financial investors, is it time to extend your chips further, or is it time to take your chips off the table now?
I don't think the length of a bull market should really have much influence on how much you are invested in. I think your asset allocation, how you're invested, should be a function of your goals and your risk tolerance, and not necessarily how long the bull market's been going on, or even necessarily what current valuations are. Because again, things can remain unsustainable and remain overvalued for a long period of time. A good example of that, one of the most popular valuation metrics in the United States is the CAPE financial ratio, the CAPE PE ratio, cyclically adjusted PE ratio. that ratio has been above its historic average for 98% of the time of the last 30 years. So, just because something is above average doesn't mean it's going to revert to average, certainly anytime soon. Things can change over time, and things evolve over time. So it's rather than taking a view that, this metric shows that it's overvalued, so you should do something different with your investing. I think just having an investing approach where you situate your investments and your asset allocation in a way that allows you to remain invested for the longest period of time without having to react to whatever's going on in the world is a much more sustainable approach.
In today's time when artificial intelligence has taken over, algorithms they call the shot, is buy and hold dead?
No, I don't think it's ever going to be dead. I think what buy and hold is betting on capitalism. Whether you're betting on a country's capitalism or just global capitalism, you're just trying to buy a slice of the global economy. And if you have faith that capitalism is going to work over time, that good companies are going to earn profits and the bad companies are going to go out of business, and what's left is going to benefit those who stick around, then I think buy and hold's always going to work. I think where it goes astray is when people associate buy and hold with the market's not going to go down. So in 2008, people said, look, buy and hold doesn't work anymore because the market lost 30%. But there's nothing in a buy and hold strategy that says the market's not going to go down. Of course, that's inherent in it. So if you do follow a buy and hold strategy, you just have to be prepared for those ups and downs and not be shocked when they come.
Would you take some sympathy with some of the active fund managers who massively underperformed their own benchmarks in the last couple of years?
I don't know if I have much sympathy for that because that's the game that they're playing. They're very handsomely rewarded when they're right, and the flip side of that is they should get no reward and no recognition when they're wrong. And I think to expect anything different is crazy.
So to talk about next 5, 10, 15, 20 years of asset allocation for an naysayer, for someone who wants to learn from your experience, for an average ET now viewer who would be watching the show, what would you say is the right thing and what do you think is the wrong thing?
I think for most investors, they just need to get to know themselves and what is their own risk tolerance. And what works for them is going to be completely different for what works for me and what works for someone else. And I think a big problem in investing is just looking at recommendations and asset allocations as stock advice that are applicable to everyone. That what is best for you is going to be best for me. When in reality, we all have different goals and different emotions. So the most important part of investing is just being introspective and getting to know yourself and what works for you and embracing that. Even if what works for you looks crazy to someone else, if it works for you, then that's great. That's maybe something I've changed my mind about a lot in the last couple of years, is looking at other people's investing decisions and rather than criticizing them, saying, hey, if that works for you, then that's great, good for you. Because what works for me looks crazy to other people as well.
And just to wrap it up with one comment, what Buffett made in his earlier newsletters, he said that if you want to retire rich, not get rich, if you want to retire rich, you start early, invest regularly, and invest in index funds. Yep. Is that a very simple strategy you would advise for our viewers here?
I think it's probably the most applicable strategy for most investors. Not everyone, but it's probably the most. It's probably the advice that is best for the greatest number of investors. And why that is because in a simple index approach, you're just giving. There are fewer decisions that you have to make. You don't have to decide what the next hot sector is going to be or what the next best company is going to be. You're just looking at it as, I'm going to own a slice of the global economy going forward. And when you have fewer decisions to make, you're giving yourself fewer opportunities to inject bias in your decision making, fewer opportunities to screw up.
Buffett, Soros, or Ray Dalio? Who's a better investor?
I think Buffett, just because he's probably been investing the longest period of time, and the longer you're investing, the more number of cycles you've been through, the greater the odds are that your success is due to skill versus luck. But I would say Soros too has made money in so many different asset classes, from stocks to bonds to commodities to futures. That too is another indication that his success is much more due to skill than luck, just because he's spread his success across so many different asset classes.
The most alluring comment from Buffett is that you should always buy fear and sell greed. What do you think you've learned in your investing career out of observing and reflecting back as the most important key takeaway which has made you a better investor and progressively you're working on it?
Well, I think there's a spin on that quote, be greedy when others are fearful and fearful when others are greedy, which is very difficult to do. It's a great quote, but to do that in real time is incredibly difficult. I have a friend named Howard Lindzen who put a spin on that quote recently, and he said what most people should do, in fact, is be fearful before others are fearful and less greedy in general. And I think that's a much more realistic approach that investors should think
One
about.
investment decision you would like to change about yourself. You say, look, if I would have not done this, if I would have not bought that stock, if I would have not sold that asset class, I would have been a happy investor.
Well, if I could go back in time, there's all kinds of things I would rather do, because everything's obvious in hindsight. But I think with what decisions I've had, or with what information I had at the time, the decisions I've made, I don't know if I regret that much. There's things, of course, if I could go back, I'd do differently. But I think it's just been a process of learning. And if you learn from your mistakes, I don't think you should regret them.
How would you define your investing process?
Mine is just as simple as it can be. I'm really just focused on time horizon and endurance. So every investment decision I make is based around, is this going to help me remain invested for the next 30 or 40 or 50 years? That's pretty much the single variable that I'm focused on.
But does that work in today's world of instant gratification?
For most people, no. And for me, it's often difficult too. But I guess one way I'd phrase it as is that I'm really just focusing on how well I sleep at night. That's the metric that I want to base my investing around. Is do I go to bed at night looking at my family and saying, everything's going to be okay, we're okay. That's my goal. And that's not everyone's goal. A lot of people, if you're an active fund manager, your goal is you need to outperform your benchmark this quarter. So that's my goal, but it's not going to work for everyone. So my decisions are based around that.
So if I have to summarize today's interaction, you're saying that first, before you understand your investments, understand and rate the quality of your sleep you want. Based on that, take your financial decisions.
That's a great metric to follow, yeah.
Appreciate your time. I hope that your jet lag is over and you have a good sleep in India.
It's not, but thank you.
Thank you very much.
Thank you.